This video is brought to you by the award-winning prop firm, Crest.
And there's one little trick that I'm going to show you towards the end that's really going to blow your mind, and how we can really almost hit 100% win rate. This is something that you can do, and it's so easy to create, and I'm going to show you towards the end. 2 a.m. candle closes bullish. What do we do? Sell it. 15 pips in and out, 1 for 1. Next day, candle closes bullish, 2 a.m. What do we do? Sell it. 15 pips in and out, 2 for 2. Candle closes bearish, 2 a.m. Buy it. 15 pips in and out, 3 for 3. Candle closes bullish. What do we do? Sell it. 15 pips in and out, 4 for 4. Candle closes bearish here, 2 a.m. Buy it. 15 pips in and out, 5 for 5. That's a whole week of trading with 100% success. This will probably work about 80-90% of the time. So if you stay disciplined with it and don't miss any of these moves, you have a very profitable system.
Crest is an award-winning prop firm that funds traders with up to $2 million and offers generous profit splits up to 90%. So one thing that really sets Crest apart is their no minimum trading days requirement on their challenge and verification stages. On top of that, traders who successfully pass the challenge and verification stages are eligible to receive a bonus payout of up to $30K on top of their funded stage profit split payout on performance. And be sure to use promo code TradingNut, all one word, to get 10% off your next challenge. Click the link in the description below or the card above to find out more.
What's going on, fellow traders? Welcome back to another video here. And in this video, I'm going to be going over a very simple, easy to follow, very systematic approach to trading time and price within smart money concepts. Now, this is only going to be 2 steps, and it has about an 80 to 90% win rate. So this is something that you can even apply starting tomorrow. This is something that I actively use within my trading alongside all my other smart money concepts confluences, but it's something that it's so easy to follow that you can't even mess it up. It has 2 steps, and it has everything to do with time and price. So why is time and price so important? Well, institutions are the ones who move the market. Why? Because they're the ones filling orders. They're the ones with the capital. Right? They are the market makers. So they move price at very specific times of the day. And these times of the day usually are between the hours of 2 and 4 a.m. Eastern Standard Time. So wherever you are in the world, you would need to adjust these times to fit your specific time zone, but I am in Eastern Standard Time. So this is going to be 2 to 4 a.m. Eastern Time. So what is this? This is going to be the London Open, or the Asian session to London session changeover. Now, this also occurs, a lot of manipulation between the hours of 7 and 9 a.m. Eastern Time. So what is this? This is actually London, New York session crossover. So these times of the day are super important to price. With the interbank algorithms setting the high and low of the day at midnight, the market already knows what the high and low of price will be for that specific day. So they're going to be trading within that range, and within that range there is going to be liquidity that is built up, and during these session overlaps and session changes, price will move in a very interesting way, sweeping liquidity, mitigating orders, fulfilling higher and lower time frame objectives. And when we understand why and how price moves at certain times of the day, we can definitely capitalize on this. So what is this strategy, and how can we implement it starting tomorrow? Well, the 2 steps within this strategy, I have found that it works best on GBP USD and AUD USD. You are more than welcome to test on other pairs, but just as a disclaimer and a reminder, this is not something that you can just apply by itself and see consistency with every single solitary day. Now, although it does have about an 80 to 90% win rate, you will still need to incorporate other confluences into your trading system to make it work successfully for you. All right, so the 2 basic rules are on the 1 hour time frame. If the 2 a.m. Eastern Standard Time, remember, This is going to be different for those of you around the world. If you're on GMT time, this is going to be 5 or 6 hours, something like that, ahead of Eastern Standard Time. So make sure that this is the right time for your specific time zone. But for me, we're going to be basing everything on Eastern Time. The 2 a.m. Eastern Standard Time candle closure, if it closes bullish, aka green candle, we're going to be selling. We're going to be doing the opposite of what the candle closure is telling us. If it closes bullish, we're selling. If it closes bearish, we're buying. The second step, what I found to work the best for me is that we're getting in and out very, very quickly. However, we're going to have to let the trade have a little bit of wiggle room to move around. But the thing is that with time and price being so precise, we don't need to set large stop losses because we're looking for the exact opposite price movement upon that 3 a.m. candle open. So I'm going to be setting and running through this test on a 15 pip take profit and a 30 pip stop loss. Yes, that is only at 1 to 0.5 risk to reward. However, when you have an extremely high win rate and you're trying to get in and out relatively quickly, but still giving it a little room to breathe, you're going to see success. And remember, like I say, it's always about percentage return. But if you can utilize win rate with your percentage return and it's overall profitable for you, then that works fine as well. All right, so we're going to go over GBP USD and AUD USD. So I'm actually going to, make this relatively simple. I'm just going to go to the higher time frame and then just pick an area where we can start back testing. All right, so we're just going to go like right in here. So what is this? Okay, cool. November 1st. All right, so November 1st, let's go to the 1 hour time frame. November 1st, what was this, 2022? So last year, so just a couple months ago. Remember, we started on the 1 hour time frame, and we're going to look for that 2 a.m. candle closure. All right, so let's just start. Let's go back 30 days, or actually 22 trading days, because that's just 1 month. And let's see what kind of results we get, and I'm going to track it alongside us. All right, so here, let's see. The 2 a.m., and you can see it at the bottom, right? You can see the time. So that's 2 a.m. right here. So what we're going to be doing, I'll zoom in. And this is the candle closure at 2 a.m. So when the 2 a.m. candle closed, it closed right there at 1.15417. All right, so what I'm going to do is highlight my ruler here. And remember, we're only aiming for 15 pips in and out, and that's it. All right, so the next candle here, we only had 5.9 pips of drawdown because we can see with that red candle right in here, you can see the wick. That was the next candle. So we only had about 5 pips of drawdown, and it would have easily have hit within that candle 41 pips. But again, we're only aiming for 15. So there we go. I'm going to write down 1-0, meaning 1 win, 0 losses. Let's go to the next day. So obviously, I'm not going to use forward testing here within this back test because it would take too long. So I'm just going to go back a month. So that was day 1, and we're going to do a whole month's time. All right, the next day in here, 2 a.m. is right here. It closed bullish. We sell off, and I don't even need to have the ruler. We can even see that it just absolutely died from there. So that would have hit take profit, would have had like less than a pip of drawdown. So next, that's 2-0. So 2 wins, 0 losses. Next day. All right, so we have a bearish candle right here. 2 a.m. closed. So we had about, in this next candle, overall 29 pips of drawdown. So that we would have stayed within that 30 pip mark, and then price would have went long 15 pips. So we would have just missed that that stop loss. If the spread was higher, then maybe you would have gotten hit out, but I'm just going to go based upon the pure numbers, 15 and 30. So there we go. That is 3-0. So far, 100% win rate so far. Next day, 2 a.m. candle closes, bearish. Let's zoom in. We had 0 drawdown when we closed there. For the next candle, we pushed up 15. So we ended up hitting 18 pips, but we only needed 15, so that would have been fine. So we are 4-0 here. Next one. 2 a.m. is right there. So we would have sold it, and obviously we would not have hit our take profit. That would have been our loss. That would have been our first loss. So now we're 4-1. Let's keep going. All right. Next day, 4, 3, 2. So we would have sold it right here after the closure. So I'm going to zoom in and see if we would have gotten that take profit. So again, we're trying to get in and out really quick. So the candle closed. If price were to have gone long, we would only been in 16 pips worth of drawdown with this next candle. We pushed down and we were in 16 pips of profit, so that would have hit take profit. The reason why my cursor is over here, guys, is because if I just try to show you the pips with this candle, you can't see the wick, so I'm just moving it over so we can see the wick there, and obviously that would have hit take profit. All right, so now we are 5-1. Next day, 2 a.m. candle closes bullish. So what do? We are going to sell it. Well, let's look at the drawdown, which we would have had. And again, remember, we could have easily pushed down first, pushed back up, and then pushed down, and then closed, right? I don't know if price in this particular day pushed higher first or lower first, right? Even though it was a bearish candle, we could have pushed lower, higher, then lower, and closed just like that, right? Because the candle is the sum of all the price action within that specific hour. So we would have closed bullish here, so we would have sold it. The drawdown would have been 20 pips, we would have been fine, and 15 pips would have easily have been hit. All right, 6-1. Next day, let's zoom out a little bit. Next day, where is that? There it is, 2 a.m. So we closed bearish, so we would have bought it right at the candle closure. We'd have had 10 pips of drawdown, and easily with this wick, 37 pips. So we're only aiming for 15, so that would have been a win. So we're 7-1. Next day, 2 a.m. candle closes bullish, so we sell it. We would have only had 14 pips of drawdown, and then we would have easily have hit take profit. All right, so another win. 8-1 so far, so looking good. Let's see. Next day, 2 a.m. Okay, we closed bearish. Let me just try to make this as perfect as possible for you. All right, we would have had for the next hourly candle, 11 pips of drawdown. We would have bought it, and that would have easily hit take profit. So now we are 9-1. So far, 90% win rate here. So it's not always going to be this perfect, but it will average about 80 to 90%. And right now, we're kind of sitting at that top level 90%. All right, 2 a.m. candle closes bearish. So what do? We buy it. And in this case, although we may have hit, we may have hit take profit, but this wick here, if we had to push down first and then close bullish, we would have hit that stop loss. So let's just call that a loss because I just want to make this as fair as possible. So now we are 9-2. All right, next day. All right, next candle here, we close as 2 a.m. We would have had 16 pips of drawdown, and then we easily would have hit that take profit right there. So 10-2. So 10 wins, 2 losses next day. 1 a.m., 2 a.m. And we can see how precise this is. The 2 a.m. to 3 a.m. candle closure is really where we're seeing a little bit of manipulation. This is going to be this London session, Asian session, London session changeover, that London session open between those hours. All right, so the 2 a.m. candle closes bullish, perfectly aligning with this system, and we would have easily hit take profit there.
All right, folks, I'm here at Black Bull Markets headquarters in Auckland, New Zealand. You can see this amazing view behind me of Auckland Harbour. Now, talking about views, if you do want to get free TradingView Pro, then all you need to do is trade 1 lot a month at Black Bull Markets, and they're going to give you free TradingView Pro. So, folks, to find out more, click the link in the description below or the card above.
So that's 11-2. Next day. 6, 5, 4, 3, 2. Candle closes bearish here. We would have bought it. Boom, that would have been another take profit. 12-2. Next day. All right, we closed bearish, so we would have bought it right there. We would have hit, okay, so this one could have been a loss because we could have pushed down first and then higher and then closed like that. But if we pushed higher first, we would have hit take profit. But just because we don't know, we're going to assume the worst and assume that we hit stop loss on this trade. All right, so this is going to be 12-3 now. So 12 wins, 3 losses. And let's continue. 2 a.m. candle closes bearish. That wick right there wouldn't have been anything. Maybe 4 or 5 pips, we would have easily hit take profit. So 13-3 is what we're looking at now. Let's see. 2 a.m. is right there. This candle was bullish. We would have bought it, or excuse me, sold it, because that candle closed bullish, and that would have hit stop loss, as we can see. So now we are sitting at 13 and 4. Candle closes bearish here. We would have bought it. Would have had an immediate push to the upside. 14 and 4. And we're going to go 22 days because there's 22 trading days in a month. Because obviously we have weekends within that time. So now we're sitting at 18 days. So we're going to do 4 more days. All right. We have candle closes bearish here at 2 a.m. So we would have had, let's see what kind of drawdown. Probably like close to none. 2-3 pips. Easily would have hit. That wick would have been 45. But again, we're only aiming for 15. So that would have been an easy 15 and 4. Let's see, next day here, 2 a.m. We can see the Asian range is going to be within here. If you scale into this region of price, you're going to see that the Asian range is being capped. You can see just very small ranges within these candlesticks because GBP USD is a London and New York session-based pair. It's not an Asian session pair. So we're going to see natural consolidation. We're going to see that fake out to the upside 2 a.m. and then the real move occurs 3 a.m. Eastern time, London session. All right, so we would have closed right there. We would have sold it, so we would have had 4 pips to draw down, and obviously would have hit take profit there. So we're sitting at 16 and 4, 2 more days to go. All right, 9, 7, 6, 5, 4, 3, 2 right here. So 2, we would have sold it, and obviously that would have been a stop loss. All right, so we're sitting at 16 and 5, 1 more day to go. 2. We would have bought it upon the candle closure here. We would have had a maximum of 23 pips, would have been fine, and then easily hit take profit. So we're sitting at 17 and 5. That's 22. There might be 23 depending on how many weekends. Let's just do 1 more day just to be sure. Always room for more data, right? 2 a.m. candle closes bearish. We would have bought it easily if hit take profit. So that's 18 and 5. All right, we'll stop there. So let's see. So we won 18 trades. We lost 5 trades. So that's 23 total trades. So 18 divided by 23, we would have had a 78% win rate. So let's now think about that in terms of percentages. Well, 18 and 5, remember, 15 pip take profit, 30 pip stop loss. So if we're risking 1% every single time, we were to have total lost 5% because those 5 losses. So 5% and then 18% on, it's not half risk, but because we're only risking 1%, 30 pips would have been that 1%, so 15 pips take profit would have been 0.5%. So every trade that we would have won 0.5%. So 18 divided by 2, you see how I'm getting that? Because 0.5%, so 18 divided by 2 is 9. So that's 9% in total that we would have won minus the 5% that we would have lost. That leaves us with 4% in total profit. And that's just 1 month, guys, on 1 pair. So now that's just on GBP USD. Let's just get out of this back test. Let's just go to another pair. I like AUDUSD. And this time, let's just go to current price. Right? I'm not going to go back and do a back test. I mean, like I did on GBP USD, I could. But let's just go current price here. I know this is my current analysis. So there we go. Some free setups for you. And let's just do another month. So another month here. So let's see. Today, this morning, 2 a.m. candle closed bullish. Again, we're aiming for 15 pips take profit, 30 pips stop loss. So in here, we would have had 4 pips of drawdown, and we would have hit that take profit easily. We would have actually have made 19 pips, but again, only aiming for 15. So 1-0 so far. Let's see. Next day. 2 a.m. candle closes bearish. We would have bought it, and that would not have been enough. We would have hit stop. So in this case, 1-1 now. All right, I love GU and I love AU. Remember, guys, it's not always going to work every single solitary day. Over the long period of time, the win rate is higher. So go back and backtest other pairs using the same system. Go back and backtest other take profit settings, other stop loss settings. And there's one little trick that I'm going to show you towards the end that's really going to blow your mind and how we can really almost hit 100% win rate. This is something that you can do, and it's so easy to create, and I'm going to show you towards the end. All right, so that's 1-1. 1 win, 1 loss. 2 a.m. candle closes bearish. Boom, right back to the upside. So that would have easily have been 15 pips, I believe. Yep, easily 15 pips. So 2-1. 2 a.m. the following day. So boom, sold. So we want to buy it. We would have had 9 pips to draw down, and overall we would have hit take profit. So now we're seeing 3-1. Continuations here. 7, 6, 5, 4, 3, 2. 2 a.m. candle closes bullish right there. We would have sold it. Let's see if that would have been enough for it to take profit because we only had 2 pips to draw down. So let's see. That wick would have got us 21 pips. So yeah, 15 pips would have been fine. 4 and 1. You can see the precision here. And this is all based upon institutional concepts, smart money concepts, just taking different facets of smart money concepts and creating strategies around them that we can look to implement into our trading. 1 a.m., 2 a.m. is right there. We would have, so that sold off, so we would have bought it. So the next candle, we would have had 5 pips of drawdown. In total, we would have had only 11 pips of stop loss. Let's see if the wick, right there, that wick would have been 20. Oh, so that's 25 pips of drawdown. So no, we're fine. So if it comes back up to the upside, we would have hit take profit. Boom, we actually would have hit 19 pips. But again, 15 pips is our target. So that's 5 and 1. Continuing here, sell off, right? That candle closed bearish, so we're going to be looking to buy it. So we bought it up, 15 pips, hit 15.3. Depending on the spread, you may not have won that trade. But again, we're just basing it upon the numbers here. So 6 and 1, next day. 2 a.m. candle closes bullish with that candle, so we're selling it off. Let's see how much drawdown we would have had. 4.5 pips, would have hit 15 pips easily. 7 and 1. Next day. 2 a.m. candle closes bearish, we would have bought it. Wouldn't have hit it. 10 pips. Then we finally spiked up. Boom, that would have easily hit it. So sitting at 8 and 1. Next day. 7, 6, 5, 4, 3, 2, 2. So in this case, we would have lost because it closed bullish. We would have sold it, and then it went long. So now we're sitting at 8 and 2. 2 a.m. candle closes bearish. Would have had literally zero drawdown almost. Just maybe a few pips right here. But then it obviously pushed to the upside. So that would have been an easy win. 9 and 2. 2 a.m. candle closes bearish. We would have bought it, and that would have been a loss because we wouldn't have come up that much. So sitting at 9 and 3 here. Next day, 2 a.m. candle closes bullish. We would have sold it. So let's see how much drawdown we would have had. Only 11 pips, and then obviously we fell all the way down. So that is 10 and 3 for our record. Next day, 2 a.m. candle closes bearish. So we buy it. Wouldn't have had much, and then we would have hit stop there. So now we're sitting at 10 and 4. Let's keep going. Next day, 2 a.m. candle closes bullish. We would have had just a little bit of drawdown here, and I'll even just show you. Would have had 4 pips, and then we would have rolled over. So that would have been a take profit. 11 and 4 is our record for the month so far. So that's 15 trades. You have 7 to go. Oh, right there, 2 a.m. So that would have lost 2 because we would have bought it with that wick. And I don't think that would have been enough. Let's see what kind of drawdown we would have had on that candle. 13, 14 pips, and then, we've only would have hit 11. So that would not have won. So we're looking at 11 and 5. Next day, 2 a.m. candle closes bullish. Would have sold it. So boom, that would have hit take profit very easily. 12 and 5. Next day, candle closes bullish. So we would have sold it. We would have lost that one. So now we're looking at 12 and 6. Let's keep going. 2 a.m. candle closes bearish. So we would have bought it. Now we would have lost 2. So that's 12 and 7. Next day, candle closes bullish. We would have sold it. Would have had 10 pips to draw down, and then overall would have had 20 pips to take profit. So 15 that would have won. 13 and 7 is what we're looking at. Let's go. 2 a.m. candle closes bearish. We would have bought it. So that's 2 a.m. is right here. So the candle closes, and we would have had 18 pips to draw down, and overall we would hit take profit. So another win. 14 and 7. Next day, 2 a.m. candle closes bullish. We would have sold it. Would have had 6 pips to draw down. Overall, would have hit right there with that wick 18 pips. So that would have hit take profit. 15 and 7. So that is 1 month. Again, like we did on GE, let's just do one more. Might as well. Let's see what kind of data we get. And then we close bullish here. So we would have sold it and easily hit take profit. Okay, so we're sitting at 16 and 7. So with this, we would have lost 7%, because if we're risking 1%, 7 losses, so that's 7%. And then 16, we'll have to divide that by 2 because that's 0.5%. So 16 divided by 2 is 8. So we would have made 8% minus that 7%. We still would have net 1%. Now, AU, this particular situation wasn't the best. We only had in total 23 trades, 16 wins. So 16 divided by 23 is only 69.5. So 70% win rate in this case. And this system usually averages between around, I would say 75, 80 to 90% win rate. So AU wasn't the best, but we still netted positive. Use good risk management and you should be good with it. GU, we had a better one. We had about a 90% win rate there. So on average, if you would have taken Aussie dollar and GBP USD as well, use them on half risk each to keep risk management purposes. If we had 70% win rate on one test and then 90% on the other, it would have averaged about 80%, which is really good, right? So that is just the simplest two-step strategy that you can even start implementing into your trading. Again, I would not recommend just using that strategy as your main strategy. Start to incorporate time and price into your overall strategy and build confluences alongside your trading. How can you build confluences? Well, like we talked about within Asian range, overall structure. So this is just a couple of confluences that you could use, because obviously I'm not going to leave you hanging out to dry here. I want to be able to teach you how you can apply this with other confluences to form a strategy, right? So let's just say, for instance, and I'm just going to make this up because this is what I see here. Aussie dollar, we're currently trending bearish. So let's just say that we created an Asian range, because this is pretty much right in here. I think that's daily candle close at 17 o'clock, which is 5 p.m. Eastern. So this is the Asian session right here. Then 2 a.m., we pushed higher, closed bullish. So that could have enticed buyers above the Asian high, right? We may have come into a prior level of structure right in here. We can see that open of the last buy to sell volume. We came back up and mitigated that and tapped into that 1 hour 50 EMA that's resting right there. Then we rolled over to the downside, engulfing, right? So that's how we can incorporate structure. Maybe there's a level of lower time frame supply in here. If we scale into a lower time frame, we can see we came back up into that previous level of supply. We had a fake out of the Asian range, buy, and then it sold off, so that huge buy to sell. Right, so that's kind of how we can start to incorporate smart money concepts using this particular methodology. Now, what's the trick, Nate? You told me that there was a trick. Well, yes, there is. How can we go from an 80 to 90, maybe 85% win rate to something that is close to 100%? Well, like you saw throughout the entire process of doing this, what was the largest drawdown that we would have had if we didn't place a stop loss, right? Throughout the entire period of that month, what was the largest drawdown? I remember, I think this was right here. To the 2 a.m. candle close, we would have sold it, so that would have been the drawdown. So let's calculate how many pips that would have been. That would have been about 113 pips. Imagine if you had of dollar cost averaged your position, if you put it into an algorithm, right? Because think about it. Algorithms are a great way to eliminate psychology from your trading, because it's fully automated, it's fully just passive, and you don't have to worry about your psychology or anything else that goes into detrimenting your trading. So in terms of creating algorithms, what I like to think about is, how can I get the highest win rate possible? And then you can dollar cost average the rest. Now, these are just basic systems. These could be turned into professional systems over time, with adding more confluences and adding more facets of the system. But this is just a very basic system that you can start thinking about creating. Right? Think about the win rate. Now, Nate, you always say risk to reward is the best. Yes, but if you're dollar cost averaging, meaning you're stacking positions, but you have to do it professionally. You cannot do it like just a typical retail trader, because you're always going to end up losing. Because if you stack very, very close together, with each stacked position being a higher lot size every time and a larger lot size every time, it will only take one significant move in the market to blow your account. But there is a way of doing it professionally. There's a way of doing it so that you can make about 1, 2, 3, maybe 4% a month, but doing it so conservatively that you don't have to worry about these big moves. Why? Because your risk is so low and you're only getting in and out relatively quick. But if you have a high win rate to start, you're already ahead of the game. Why? Because if you're dollar cost averaging, if you have an 80% win rate out of 10 trades, you already know that 8 of those trades are going to hit take profit immediately, almost zero drawdown, right? Then there's 2 trades that don't hit take profit immediately. Those are the 2 trades we have to think about dollar cost averaging. So what if those trades get into drawdown? What kind of drawdown would we assume, and how could we get out of those trades? So what you could do here is back test the system over years and years and years and think, hey, if I were to just in a matter of 1 month, right? We lost 7 trades, won 6, we would have made 1%. However, of those 7 trades, what was the largest drawdown that you would have seen if you didn't have a stop loss? And I think that would have been just this move here, right? Over the last month. And that was what, 113, so let's call it 115 pip stop loss. Or excuse me, not stop loss, 115 pip move against you. So you would have sold it right there, right at that level. And then what you could do is place maybe an additional position every 50 pips. So 50 pip there, maybe another 50 pips here, boom. By that time, it rolls over and then it gets you out of the position. If not there, then right there. So that way you don't close in a loss, but your lot size to begin with is so small that if you do get into drawdown, the drawdown is not large at all. So you can preserve your capital, stay in for the long run, and make incremental gains over time. So this is not only how you can incorporate this into your manual strategy, but how can we expand and incorporate this into algorithmic trading? This is the type of mindset that we need to be having if you guys are algorithmic traders. If you're not, don't worry about it. There's still ways of implementing this into your manual system as well. So right here, let's just say we would have had, if you had a 10 grand account, let's just make up a lot size, let's just say 0.02, right? Then that's 20 cents per pip, 15 pips. What would that have been? Can't even do math. 15 pips times 20 cents. You would hit $3 every single trade. But remember, if you do this every single day and you're getting out of every single position in profit, right? So every single trade, whether it gets into a little drawdown like it did here, and then it finally got out, or it's hitting take profit immediately, every single trade you are making $3. So $3 times 22 trading days a month, that's $66. Divide that by $10,000 accounts times 100, that's 0.66% a month. That's just on one pair. You do this on a few pairs. Let's say you do it on 3 or 4 pairs. Say 4 pairs is probably the maximum. That's 2.6%. Heck, let's actually do it 3 pairs. That's 1.98%. That's 2%. Boom, 2% a month. Multiply that by 12, 23.76%. Boom, you're beating inflation. You're beating the benchmarks. You are doing a very reasonable, sustainable return and an expectation that is realistic to market gains, right? You're not doing things so crazy to where you're trying to get 10% a month. Do you think hedge funds really get 100 to 120% a year? That's 10% a month? No. They get 15 to 20% a year because they understand risk and long-term sustainability. And when they have a system that's long-term, sustainable, professional, then all you have to do is scale, because then you're making more money on the same return because you have a higher account balance. And that's where we can, you can get funded and you can run these sort of systems on that. Imagine hitting 2% on a 100 grand funded account. Boom, $2,000, having you done nothing, and it's a simple strategy. And this is just a very basic system that you can implement. There are other ways in which you can go about it, and more professional ways of adding in different variations, different facets of the strategy to make it a lot more conservative, to maybe even make higher returns. But this is the type of thing that you can think about. All right, guys, so I hope you enjoyed this video. Thank you very much. Have a great rest of your day, and stay tuned for more videos like this. Take care.
Tired of missing trades or spending hours at the charts? Introducing my Robot Builders Club. With our platform, you can build bots in minutes, not weeks, without any coding required. Get lifetime access to my video course, VIP community, and over 40 ready-made robots. Works with MT4 or MT5, and as a bonus, you'll get 3 months access to my robot lab, where we build and test bots on live calls every week. Join the hundreds of traders who are trading smarter, not harder. Click the link in the description to learn more, get the free training, and download a free robot.